Have you remembered all of the things you need to do before the end of this year? Keep listening to find out. So Justin, I thought good time of the year, last few weeks in December, to do an episode on some financial checklist items, and maybe not checklist items, but maybe just some reminders of things you need to be taken care of. Because as the year winds down, this is naturally the time that people start thinking about some of these decisions. And if they're not, maybe they should, myself included. I recently did several of these things on this list within the last 7 days myself. And so I thought it was a great time to have that conversation. I know that you're going through some of these conversations with your clients too, right?
Yeah, we're literally running this checklist plus a couple other items with every single of the 80-ish households that we're serving right now. So I love checklists. I'm a big believer in them, improve quality control. We're getting a lot of fancy new robot-driven tools out there, but it's hard to improve upon the checklist as a mechanism for making sure you got your bases covered. So I'm excited for today's conversation.
Yeah, we're all about checklist and anesthesia too. It's a safety patient tool as well. So as we talk about the end of year financial tasks, it may make you also think about your goals for next year. And one goal you may have is to improve your financial literacy. And a great way to do that is actually to get a personal finance lesson emailed to you once a week. And that's exactly what you can get by joining the Money Meets Medicine update. It's a weekly email, includes that personal finance lesson, but it also includes the week's content, including the blog post that's written each week. And it also has exclusive deals and discounts for Money Meets Medicine community, like $100 off student loan consult or $100 off physician contract review. So you can get that personal finance lesson sent to your inbox once a week by going to moneymeetsmedicine.com/update. One email once a week. That's it. All right. So Justin, one place we can start here, and I literally just went through all of these myself. And so, or at least many of these, particularly because I was switching jobs, which we'll talk about in the next episode, but also just because it's the end of the year and I'm sitting down, putting my ducks in a row, and listeners may have gotten this at this point that I'm not the most detail oriented person. So I'm a big picture, like take complex things, make them simple kind of guy. And because of that, sometimes these details get left until the end of the year. And then I'm like running my books for my businesses and running all the the revenue and the expenses and cataloging things and figuring it all out. And so this made me feel like it was an apt time to have this episode. But the first thing to talk about is maybe taking category or inventory of your tax advantage accounts and making sure that you're filling them up. And I'll add a caveat here, because this doesn't just mean like, hey, whatever tax advantage accounts you have, fill them all up. It means, hey, what is your number you're trying to save each year? And then are you taking advantage of the tax advantage accounts to get to that number? Are you thoughtfully thinking about pre-tax versus Roth? Like just kind of having that conversation and thinking through that process. And this is a really good time of year to make sure that you're looking at your pay stub and saying, hey, am I actually filling up the 403B? Because actually I've had this happen because we've switched HR people at Wake. And in the midst of that, we had to make sure that what was previously being contributed and what is now being contributed were the same numbers. And I wasn't going to overfund or underfund my 403B at Wake. And so this is something that I went through in the last 6 weeks myself because of that change. And so what are some big picture items in terms of accounts we really want to make sure we aren't missing here when we're thinking through this?
This is a good opportunity to revisit what we affectionately call the tax optimized savings hierarchy, a bunch of financial jargony words all strung together, which basically means if you're going to save money, do it in a way that makes your tax position the strongest possible and keeps your bill the lowest possible. And so if you're an established attending and have been for a while, what that typically means is you make sure that all the pre-tax accounts to which you have access, 401k, 403b, 457 potentially, depending on the type of 457,
we'll talk about
HSA, dependent care FSA, all of those are pre-tax deductions, as long as you're saving in the traditional bucket of those accounts. And so often maximizing your contribution into that account, always maximizing, and often in the traditional compartment of that account is worth revisiting. So your most recent pay stub is the best place to figure out if you're doing that. Depending on when Dr. Turner releases this episode, you might still have a pay cycle or two left in 2025 to make any last minute adjustments. And then you'll have the opportunity in 2026 to make any tweaks for the new year. For physicians who are career transitioning, either from training to attendinghood or from one attending role to another, it's very important that you coordinate contributions between employers, because typically if you only work for one employer, you're automatically going to be capped with that $23,500 if you're under age 50. And you get the catch-up contribution of an additional $7,500 of employee deferral if you're over age 50. You'll automatically be capped by HR. But if you move in mid-year and you've already made $15,000 of contributions at the old employer, your new employer isn't going to know that, so they're going to let you go all the way to $23,500, and then you're going to have a little bit of it's not a big deal, but you're going to get some money kicked back to you after the new year, and it's easier to avoid. So do the math, make sure you're maximizing those accounts to the extent that it is your desire to do so.
One other point of transition that happens all the time, I get emails about it all the time, is the person going from training who's been saving in a Roth IRA, and then they become an attending in that second 6 months, their income from being an attending kicks them over the limit where they could have directly contributed to a Roth. And so if you're in your last year of training, then you need to be thoughtful about how you're putting money into a Roth IRA, because you may go over the income limit, not because of your first 6 months when you were still in training, but because of the back 6 months when you weren't. And that causes some restructuring fiascos and Form 8606 nightmares that you may not want to take part in. So as you're listening to this, if you're going into that last 6 months, January to June, which are about to happen here shortly, and it's your last year, think very hard before you put money directly into a Roth IRA.
Great point. I have unwound a few of those. It's not a huge deal. It's kind of annoying. If you don't already have a CPA, you're going to probably need to get one. So it is one of those moments where often there have been a few, we'll call them 8606 snafus, that have driven physicians into the arms of a financial advisor. And frankly, like, that's probably a good time to, if you're not inclined to continue to stay up on these techniques, it's not a bad idea to start delegating part of your financial life at that point.
Yeah, one other thing to call out too, and this is related to Roth IRAs actually, in terms of backdoor Roth IRA conversions and HSAs as well, is those are the two accounts that I find most often people put money into and then they forget to actually invest it. And so this is a good time of year to actually go into that Roth IRA or into your HSA and to make sure it's not just cash sitting in a settlement fund that has actually been invested, because it is hilariously common for people to be like, oh yeah, I'm investing in an HSA, and they've got $40,000 in it. It literally has never been invested. It's just been getting eroded to inflation because they never put the money in the market. You actually have to invest once it gets inside the HSA. And so add that to the checklist for any HSA or backdoor Roths you may have made to make sure it's not just sitting in a settlement fund inside of one of those accounts. So that really got a big picture stuff for like a W-2 person. And I live a little bit in both worlds because I've got the W-2 income as a physician, but then I've also got outside income from business ventures. And maybe an important caveat just to throw out there, don't have to necessarily dive into the weeds on this, but you do need to set up your solo 401k or your SEP IRA if you choose to do that for, let's say you're a 1099 physician, or you have businesses outside that you've got money you want to invest. You need to be thoughtful about how much money you put in that based on your numbers. If you're investing inside of accounts in other financial situations, like having a W-2 income, be careful how you do that math. But I'm mentioning it now because you do have to start those things and fund them before December 31st of 2025 for them to actually be effective for that tax year.
Not technically true.
No?
Depending on employment status. If you're self-employed and you're 1099 and you're not W-2 within the self-employment. So if you do consulting on the side and you make 75 grand from XYZ medtech company for your efforts, you have up until the tax deadline to do the SEP IRA or the solo 401k. Tax deadline would include extensions. So you actually would have, we have some clients for whom until October. However, if you are self-employed or you're 1099 and it's your main gig and you make 500 grand 1099 and you run payroll for yourself, it is necessary to make the employee deferral. It just gets more complicated. So you're going to deal with a year-end deadline for funding a portion because it has to be reflected on your pay stub, and you're also going to have constraints about how much you can fund based on the wages that you're showing. So if you're in that zone of like, I'm self-employed, I run payroll for myself, it's a one employee firm that's just me, or maybe I include my spouse. I mean, frankly, you're probably already working with an advisor and or a CPA, but you're in the zone where it gets complicated quick. And so make sure you get some qualified help.
Yeah, that's a good call out. Appreciate you mentioning that. So let's move on to the second thing, which is the thing that I just went through. That's calculating your tax withholdings and making sure that you're within the safe harbor. And so if you're listening to this, you don't know what the safe harbor rules are. Basically, you have to be within 90% of this year's total tax return, what you're supposed to owe, which I'll be frank with you is kind of hard to calculate. Or you need to pay 110% of last year's taxes if your income's above 150. And so for me, I'll just be honest and say that it is challenging based on income that's coming in from different sources to fully appreciate what does 90% of that number actually mean, and getting that right is hard. It's much easier in terms of simplicity to pay 110% of the prior year's taxes. But I also don't like giving free money to Uncle Sam that I could be using for my purposes and then have to wait until April or May to get a 5-figure check back because I overpaid on my taxes. And so that said, it's really important to do the math and make a decision about which way you want to try to tackle that, trying to be within 90% of this year's, what you will owe, or 110% of last year's based on your last year's taxes. And for that reason, you need to look at your pay stubs. You need to look at any other sources of income. Maybe you have 1099 income on the side. Maybe you've got a business on the side. Maybe you've got some other stream of money coming in. The W-2 money is going to be taken out naturally from your paycheck. And to be frank, depending on how you fill out the forms, it may or may not be an appropriate amount of money. And so it's common for me to talk to people and they're like, yeah, like I just did the math and like, I feel like I took out 15%, but last year my average tax, I think according to my accountant was 25%. And it's like, yeah, you probably filled out a form wrong where they're not taking out as much money as they should. And then they get the surprise $20,000 tax bill the next year. And so you don't want to be in that situation. And for me, doing it in December, to be honest with you, gives me a little bit of peace of mind and the ability to sleep at night, because I also know that if I don't file my taxes until March or April, I've got a few months to figure out where that money's going to come from. If I have a shortfall of some kind, I don't have to pay it January 1st, but now I have at least a heads up to, hey, you need to start saving for this $15,000 tax bill based on the math you just did. Run your taxes, find out if that's actually true, and then you have that money available to pay for, as opposed to finding out when your accountant runs your bills and then you go to file your taxes. You're like, oh gosh, I got to come up with $15,000 now, which is a lot less comfortable in my opinion.
I would also point out, if you are transitioning employment with the same employer from training to attending hood, or maybe you're coming back to the place where you used to be a resident or fellow after going somewhere else, I have observed there's some noise in the HR machine that grabs old data. And I've had clients where they're massively under withheld when they're all W-2 and they're high income. I think it's related to a W-4 they filled out when they were in training. And turns out they were like 9% withheld to the Fed at an income of $500,000. Turns out you're going to have to cut a big check and you're going to be paying some penalties and interest. So if you're in that employment transition, it's your first year in a new job or something, I would recommend just look at your pay stub, look at your federal withholdings year to date, look at your federal gross wages, and just as a sanity check, figure out what is the effective rate that's being withheld right now. And am I kind of close to my expected total liability? And if you're like 8%, and you're going to owe 200 grand and you've only withheld a small fraction of that, then you can at least, to your point, Jimmy, like you got a few months to start stacking the paper to
figure it out. Yeah. And a story that we tell every year when we have this conversation is about 1099 income, because you don't learn about business in medical school or residency. You often don't learn about personal finance and certainly taxes. And the physician story that just lives on in lore of the person getting paid 1099, not realizing that they weren't having any taxes taken out, because you are your own employer in that situation. So you have an employer and employee taxes. So it's even higher. And then finding out when they go to file taxes, they had all this money due because they assumed that money was coming out of their paycheck like it did in residency when they were earning a W-2 income. So if you're being paid a 1099, you do actually have to pay taxes on the employer and the employee side. It is a consequential number. And I have known a physician who got put on basically a payment plan by the IRS to pay it back because it was such a large number and they couldn't pay it immediately, after realizing, oh gosh, my first year as an attending, I didn't realize that was necessary. And so calling that out, if that's you, make sure that you're paying taxes, whether it's from your employer as a W-2 or as 1099, however you're earning your income, you do actually owe taxes based on the money that you owe. So a third thing to mention here to dive into is just kind of investment pieces and portfolio cleanup. I mentioned on a prior episode about tax loss harvesting coin. And so, in fact, I wrote an ultimate guide on Bitcoin tax loss harvesting because I really dove into the weeds. It's like a very long post. It's pretty much everything you want to know.
Bitcoin went down. Why would you have to tax loss harvest?
Yeah. Making fun of me. Yeah, it's gone down.
Just kidding, guys. Don't send your lawyers after me. It was a joke. It was a joke, okay?
Down 30%. But all that to say, there is that ultimate guide on the blog if you want to go check that out for that. But we're talking about just tax loss harvesting in general and being abreast of what your capital gains look like and your potential capital losses look like. Are there opportunities to give capital gains to a donor advised fund or give capital losses to tax loss harvesting? And hopefully that's something that you're doing throughout the year. And this isn't just necessarily a December sort of thing, but as you're thinking about these things, this task may kind of come up on your radar and you're like, oh, I wonder what my overall gains or losses are. Are there opportunities there from a tax standpoint to take advantage of that? And importantly, this is also a great time of the year to consider rebalancing your portfolio. So everyone does this differently. If you have an advisor, it's going to be a little more active of a asset rebalancing that happens in your portfolio. If you are Jimmy, that's going to happen like once a year. And I'm going to make sure that my portfolio is not the most unreasonable thing in the world based on what happened in this preceding 12 months. And so I want my asset allocation to be what my investment policy statement says it basically should be, right? And so it's a good time of year to think, okay, hey, maybe I need to look at my investments and stock market went off like gangbusters this year. And so now I'm 95% stocks and 5% bonds. And I really want to be 85-15. So now we need to think about restructuring things to get back to the asset allocation that you want. And so everyone's situation is different in terms of what the right asset allocation is for you, but you should be rebalancing to the asset allocation that is right for you that you've determined.
I would also point out, in a year where there is a dispersion between the returns of various asset classes, that is a time at which rebalancing is going to be more important, because it's likely that you will have moved further from your target weights. This is particularly true for folks who are perhaps approaching retirement and maybe closer to that, like the typical 60-40 setup. If you're 60-40, you're going to drift a little more than if you're 90-10, just because there's less bonds to move. But stocks were way up this year. International is up 20 plus, and domestic is up in the low to mid teens as of the recording of this episode. And so adjusting your mix from domestic to international and adjusting your mix from stocks to bonds, particularly if you have that 60-40, 70-30 weighting, it's an important time to revisit that.
Yeah, absolutely. And this brings us up to a fourth topic to consider, which is related: charitable giving. So I mentioned donor advised funds and the opportunity to donate appreciated shares that have grown in value. You look at your investments, you have capital gains that are in there, and you could give those to your donor advised fund and allow for tax savings in the year in which you donate to that donor advised fund. And so you could theoretically front load a few years worth of donations in a single tax year. And you got to be careful about how much you can do based on your income. There's a percentage limit that is there. But all that to say, it is a way to lump some money into donor advised funding. And historically, this is something that I used to do. In fact, the time that I started doing this was hilariously bad timing, which was I was going to double up my charitable giving in years 1 and 3, and then take the standard deductions in years 2 and 4. And then the One Big Beautiful Bill Act was written, and taxes have changed. And now the SALT tax much larger. And so there's actually a benefit to itemizing potentially every year, depending on what your income is going to be. And so that said, I did lump sum 2 years worth of givings last year that covered 2024 and 2025 that I don't know, I may or may not be doing in the future. But what I will say is having a donor advised fund now, it's been pretty cool because the market has done well during the time which I gave that money. And so the amount of money that I was giving each month, that the length at which I can continue to give that money was prolonged by several months because the portfolio was still earning money, still growing, the investments inside of it. And so as I spit off those checks for the amount that I'd predetermined I wanted to give every month, I'm looking at it and it should have something like, I don't know, 5 months left, and it's got like 12. And so, I mean, it was a significant difference. So it allowed me to give more money to the charity, right, to my church specifically, than I would have if I just given it every month from my paycheck. And so some people view this as like, oh, you're taking a tax advantage, like what a jerk, like just give the money to the church from your paycheck. And actually, I'm going to be able to give more money to charitable things that I care about using that method than if I hadn't. And so it actually ended up being beneficial for the people I was giving the money to, for me to use that. I thought that was pretty cool.
I'm a huge fan of donor advised funds, particularly when coupled with the SMA, as we've discussed, the individual equity purchasing with the tax loss harvesting built in. That can be a real sort of wind in your sails in terms of giving. And to your point, Jimmy, it is important to note that the One Big Beautiful Bill has changed a lot of the previously much more straightforward calculations related to the SALT deduction, which goes from 10 to 40,000 with a phase out. So depending on how much income you have, you might still be receiving only $10,000 of deduction from the SALT tax deduction. But you got to sort of circle the wagons with your CPA to see how this is going to impact you for 2025. It's probably different than last year if you're in sort of the typical, we'll call it 250 to 750 of income in that sort of physician window there.
Yeah, really important to consider. And correct me if I'm wrong, is this true too that you need to fund the donor advised fund by December 31st, or do you have an extension until the tax line?
Contributions to the donor advised fund, if they're going to be counted in the current tax year, need to be made by December 31st. And make sure that the securities you're donating are long-term capital gains and not short-term capital gains. If you haven't held it for 365 days, you only get a deduction in the amount of the basis of the shares, which would be very, very sad. Your church doesn't care because they're going to get the same amount. But if your Tesla stock, you bought at 100, it goes to 500, you move it to the DAF, you only get a $100 deduction. And that is sadly suboptimal.
Yeah, that is suboptimal. So let's talk a little more about self-employed 1099 physicians. And we talked about me running my books and going through the expenses and the revenue and doing, profit and loss statement and figuring out, okay, based on this, how much money do I owe? Are there things that I can do? Do I need to accelerate some expenses that I'm going to have in 2026 to 2025? If I have an extra $15,000 in profit sitting in one of these accounts, and I know that I'm going to have to pay taxes on that, whether I distribute it to myself or not, that's how that works. You still owe taxes on the money. I might say, hey, I know I can pay for $10,000 worth of stuff right now in 2025 that I know I'd be paying for anyway in 2026, and lower that amount of profit that's on a balance sheet. And so there are things that you can do thoughtfully about that time frame in order to avoid paying more in taxes. But you also mentioned on here something about confirming your payroll status. So what's that all about?
Yeah, so if you are self-employed and you're running payroll for yourself, there's a whole litany of things you need to be aware of. And you're a business owner at this point. So you have the sort of business owner complexity to deal with. And so you need to make sure, if you are in this situation and you're running payroll for yourself, that usually means you have like a couple to a few $100,000 or more of income, a sufficient amount of income so that the savings that comes from doing the S election or being an S Corp exceeds the cost of the increased tax complexity. So what that means is you're going to have to review the wages that you're paying yourself, meaning what is my salary? How much am I running through payroll for myself in this calendar year? Whether it's 100 or 200 or 300 or 500,000, is that salary going to be deemed reasonable by the IRS? Because the IRS wants you to pay as much payroll tax as possible, but you obviously want to pay as little as you legally reasonably can. And the place where that battleground is often manifest is on the wage that you choose for yourself. So examining the wage. If I'm, for example, I'm a pain physician, I run a practice, my practice made $2 million last year. I need to pay myself a wage that is representative of the physician clinical duties. So one way to think about it is, if I wasn't doing anything clinically and I had to hire somebody to do the work that I did in the clinic, how much would I have to pay that person? I like going to the BLS.gov, Bureau of Labor Statistics, to begin to approximate a good number, but maybe it's 300, maybe it's 400, maybe it's 500. You can see if the number is 500 and I made 2 million in the business, that means I got 500 coming from wages. And then I've got 1.5 million that's coming as profit, which is going to be taxed at a lower rate. And so one of the challenges or problems or danger areas comes in is if I pay myself 75 grand or 100 grand or zero in wages, the IRS is going to wag their finger at me and maybe knock on my door and say, let us see your books because you're not paying us the payroll taxes that would only be paid on the W-2 wages. So if your wages aren't enough, the IRS will hit you on the knuckles with the ruler. So you want to make sure that your wage is reasonable, that you are running payroll appropriate for your position. And if you are doing a 401k or a solo 401k, to sort of call back to the earlier example, you need to make sure that the employee deferral, meaning the contribution that you make as the employee that comes out of your pay every pay cycle, is reflected on your W-2. There is a year-end deadline for that. So if you're like, this is my first year being 1099, I'm so excited I can finally do a solo 401k, and you open the solo 401k and you think, I'll just make the contribution at the tax deadline. If you're paying yourself wages, there is an interaction between your max contribution and the amount that shows up on your W-2 in terms of wages paid. So just make sure you're working with your advisor or your accountant to optimize that, because if you haven't paid yourself enough wages, or if your 401k contribution is not reflected on your payroll by the end of the year, you can't go back in January and fix that. So you need to do that this month.
And I'll just blatantly call out the fact that if you're in that situation, it is highly, highly likely that you would benefit from having both a financial advisor and a very good accountant. And having dug into these things myself, because I like learning about this stuff, and then having conversations with you, Justin, and with others, like the potential tax savings in some of these situations is absolutely massive. I mean, the difference between just getting paid as a sole proprietor or electing an S Corp on $2 million and the difference in taxes you'd pay in that situation is such a large number that you would easily pay for multiple financial advisors and accountants in that situation. And so,
they would all gladly take your money.
Yeah.
You never want to pay a fee in excess of value. Whenever we're talking to prospective clients, we always want to make sure that if you're going to pay us for our professional services, that we can give you something that's worth what it costs. And in these cases, it's basically a slam dunk every time. It is very easy to provide value significantly in excess of fees. And usually it's like dollar for dollar. I can show you, like, I'm literally going to save you $14,000 in taxes right now, and here's how it's going to work. So definitely, if you're in that situation, talk to somebody who would be advised.
Yeah, and I actually ran across the pass-through entity tax strategy the other day because I was running into the SALT conversation. And I'll let you look up the limits for SALT deductions yourself, but there is a limit for SALT deductions. And as you phase out of that limit, you go back from that $40,000 increase that the One Big Beautiful Bill Act put in place. I'll just tell you, it's at $500,000. And then it phases out to back to the original $10,000 to $600,000, I believe. I think those are the numbers. But if you're in a situation where you're making money and you're being paid as a sole proprietor at $600,000, you're going to get $10,000 in SALT taxes, as opposed to if you take this pass-through entity tax strategy approach, you can now deduct some of those state taxes. So North Carolina is like 4.5%, give or take. And so you can take 4.5% of that $600,000 and deduct it through that method if you were an S Corp and you were doing some of the other things you just described. And so that's another bucket of savings that someone could potentially have in that situation. But I will say that learning about this stuff, it does get complicated enough for me where I'm like, I would not touch this stuff with a 10-foot pole if I didn't have a very good accountant helping me sort this stuff out.
Yeah, and this is actually another important, potentially high stakes area, the pass-through entity tax, paying from your S Corp. It varies by state. It's whack-a-mole. Like every year, even within a single state, the rules are changing because it's like this duel between the Fed and the state about who is going to get the most money, essentially. And so there's this back and forth, whether or not it's allowed, or maybe there's a give back on the state return. And it does get very complicated. So I would say, A, the stakes are high. It could save you $5 or $10 grand in taxes or more, depending on your tax bill. And B, it's complicated enough that you should probably talk to a CPA. So if you're a business owner and you're currently like, geez, I hope you're not like DIYing your corporate returns. And if the pass-through entity tax is something you've never heard of, then this is an opportunity to have a professional come alongside and assist with your tax strategy, and it could be very beneficial for you.
Yeah. And so some other things to consider at the end of the year, maybe 6 categories: insurance and risk protection. And this is just a reminder to make sure that you actually have the protection that you need, right? So you've had a kid this year. Maybe you should go consider some estate planning, right? And some wills. Maybe you should have an attorney draft up some of that for you and have that conversation about what things go where and what happens to what when the unfortunate happening of your death should occur. And speaking of which, you need to make sure that your life insurance coverage is appropriate, right? Like, are you still paying for an appropriate amount of life insurance? Have you gotten to the point where you're 55 years old and you're very, very financially independent and you no longer need your term life insurance? You know, maybe that's a consideration for this time of the year. For those that just finished training in the last 6 months, have you increased your coverage for disability insurance? Because you do need to do that when you finish training, because the amount that you have covered from when you were a resident is probably insufficient to cover you when you became an attending. And so as you think through some of these, I think an important category is just considering your risk protection from an estate standpoint, from a life insurance standpoint, from a disability insurance standpoint, and particularly if you are in a period of transition, whether that means having a kid or you just finished training or you're changing jobs, and maybe the job A has a different kind of life insurance coverage than job B, and that impacts the amount of total coverage you have. So just think through that as you're going through this end of the year time. And maybe the 7th thing I'll mention is just some other year-end transactions, I guess, as we categorize this, Justin. So maybe you can talk to us about those.
Sure. So there are a number of financial transactions that in order to get them to count for the current tax year, it's not a tax deadline, it's a calendar year deadline. So 529 contributions if you have kids and you want to save for their education. There are a lot of states where you get a nice state income tax deduction. Some it's actually like quite large and uncapped. So you want to understand with the state I'm living in, A, do I have state income tax? B, is there a credit or a deduction associated with the state income tax? Is there a phase out? Is there a limit to the max contribution that I can make that gets deducted? And just figure out what that is for your state. It's pretty easy. Just Google or your AI platform of choice, put in your circumstances. And this is a question that's typically simple enough that you can get a solid answer from any of those. But if you want the deduction in the current year, you've got to do that by December 31st. RMDs is another one, required minimum distribution. So if you are older in your 70s, or if you've recently inherited an IRA, meaning in this case, it would be generational shift typically. So like if your parents passed away and they had a 401k or an IRA of which you were one of the beneficiaries, you would have an inherited IRA and you need to kick money out from that every year. So you need to do that typically by the end of the year. And so sometimes there's a waiver for if it's the first year, but you need to make sure that that distribution is done by the end of the year so that it can be taxed in the current tax year. Roth conversions, again, for physicians who are typically, like the ones who would be thinking about this are maybe they're post-career, pre-medic, pre-Social Security, also maybe pre-Medicare. They're in the 50s, 60s. Their income is lower. they've got a bunch of traditional assets, so 401k, traditional IRA, and maybe not a lot of Roth assets. Maybe all the blog posts on Backdoor Roths didn't exist back when you were really in the accumulation phase. And now you're wanting to reconfigure your sort of tax buckets to optimize for the likely multi-generational lifespan of those assets. In other words, if you're 60 and you've got a kid that's 30 and your kid is going to end up with some of your assets someday, you don't want them to inherit your assets at age 50 when they are 50 years old and they are making a lot of money, and they're going to have to kick out their beneficiary IRA at the top marginal tax rate. It's much better for them to have a Roth IRA and have that tax preferred treatment stretched out over their lifetime. So Roth conversions, this is a good time to, you got to convert by the end of the year if you want that to count for this tax year. And then finally, tax loss harvesting, and in some cases, tax gain harvesting. Jimmy, you talked about tax loss harvesting in Bitcoin. In some cases, maybe you bought a mutual fund like a long time ago and it just went up, and you don't really like it anymore, or it's too concentrated, or there's like reasons that you want to diversify away from that, but there's a ton of embedded gains and you don't want to take the tax pain of ripping off the Band-Aid right now. You can observe the losses that you harvest in a given year and say, maybe I got 10 to 20 grand of tax losses that were harvested from Bitcoin because of the sell-off in the last couple months. If I realize 20K of losses, I can realize offsetting gains in appreciated positions to diversify away from this holding that for whatever reason, it's not a good fit for me anymore. And it's a tax neutral trade, meaning I'm not paying any taxes because I have losses to offset the gains. So doing that within the tax year is something that you can do. And it probably makes sense to just go ahead and do it as soon as possible in that case.
Yep. That's a good way to close it out. A little bit grab bag section there. But so looking back, we had maxed out our tax advantage accounts. Consider your tax withholdings and whether you're in the safe harbor check. Look at your current taxes. Are you on track to pay them all? Talk about investment portfolios, cleanups, rebalancing as number 3. Number 4 was charitable giving strategies. 5 was a special note for self-employed or 1099 physicians and considering their payroll status and the way that they structured their business. 6 was insurance and risk protection check. And then 7th was some other year-end transactions, including 529s, RMDs, Roth conversions. So that's a pretty good list. It's not a completely exhaustive list, but it'll get you most of the way there.
I like to call that comprehensive, but not exhaustive.
I like that. That's a good way to put that. Should put that in the show notes. Everybody, thanks for tuning in as always. Make sure to like the show, subscribe to the show, leave a review on the show so other people can find it. And as you head out, don't forget to join the Money Meets Medicine weekly update to get that personal finance lesson sent to your inbox each week. You can do that by going to moneymeetsmedicine.com/update and enjoy all the good stuff in that email. We will see you next week. Cheers. Justin Harvey is a certified financial planner at APM Wealth, where he helps anesthesiologists and pain medicine physicians. Dr. Jimmy Turner is a practicing academic anesthesiologist at Wake Forest in North Carolina. He's also a licensed insurance agent. However, either Justin or Jimmy are your financial planner, investment advisor, or insurance agent. This show is expressly for general education and entertainment purposes only. Nothing should be considered financial advice. All views expressed are solely the views of the guests on the show and do not represent the views or opinions of their employer.